Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. Well, artificial intelligence was in full focus this past week as Elon Musk is combining SpaceX and his XAI in a deal that values the enlarged entity at $1.25 trillion. Tim, that's a lot.
It is. And an AI automation tool from Anthropic sparked a rout in stocks across software, financial services, and asset management. The latest evidence that AI applications have expanded from web-based chatbots to algorithms that can automate a slew of enterprise workflows, and that's got some investors freaked out.
It does indeed. We also got an update on the AI spend and impact thanks to earnings from Alphabet, Amazon, and a few others. As for Alphabet, its CapEx, man, it was a bit of a shocker. We'll have more on that in just a moment.
Plus, a volatile week for precious metals and a Substack post from Michael Burry noting the recent slide in gold and silver amid a warning about Bitcoin's recent plunge and how it could deepen into a self-reinforcing, quote, death spiral. Some thoughts on that in this hour, too.
We'll also talk about using drones and cloud seeding to bring snow to the slopes. That's in our second hour.
All that to come. We begin with earnings from Alphabet, one of the two Mag 7 to report this week, Amazon being the other. The Google parent, which is one of the world's largest market cap companies, reported a CapEx spend number that blew away Wall Street estimates.
It certainly did. It had the stock bouncing around a lot. Breaking down the results as they cross the Bloomberg, we take you back there and to our chat with Bloomberg Intelligence Senior Global Head of Technology Research, Mandeep Singh, and Dan Ives, Global Head of Tech Research at Wedbush Securities. Dan's Wedbush AI Revolution ETF counts Alphabet as the fund's third biggest holding. Mandeep kicking it all off, honing in on that CapEx spend by Alphabet.
When you think about the year-over-year growth rate for 2026, we are talking about almost a doubling of the capex. They were around $95 billion for 2025. So at the high end, we are, talking about doubling. Look,
that's huge.
We thought
2025 was a big year.
No, and after the Meta print, it became obvious that these companies are going to step up in terms of their capex spend. So,
but this is but as you've reminded, this is different than Meta because Google can use this capex to then sell to other companies for Google Cloud,
which actually saw a pretty nice sequential acceleration.
Meta Platforms doesn't do that.
Meta Platforms doesn't do that, but these companies also consume a lot of the GPU and the AI infrastructure capacity in-house. And look, they gave a token count number again, which I always look for. And
the 10 billion tokens per minute?
For their APIs. So that just goes to show the trained LLMs are being used in the real world. And in the case of Meta, yes, there is a higher uncertainty around how their GPUs are being used. But in the case of Alphabet, you see it in the print in terms of Gemini MAUs going up to 750 million, the API token count going up. So cloud revenues accelerating, search growing 17%. That's all AI overviews. Only thing that disappointed was YouTube. I just don't know why.
So that wasn't a disappointment.
There was. And look, Meta just came up with a quarter where they grew 25%.
Yeah.
And they raised the guide to 30% next quarter. So from that perspective, YouTube was light. And I don't know the reason why.
Okay, so that's certainly a question that's got to be pushed on the call. Going back to search, I mean, they talked about exceeding $400 billion for the first time, annual revenues in total, and you talked about some of the other usage points. So the payoff, the ROI, we're clearly seeing when it comes to Alphabet.
I mean, for a business that's a $225 billion run rate to grow 17%, and at an incremental margins of 70% or 80%. I mean, search margins are probably the envy of the world in terms of, how much money they print from search ads.
How come my Google Home is so slow, though? Because since they added AI, it takes forever to get an answer.
Well, I mean, look,
maybe you need a new Google Home.
Yeah.
Or you need to update that connection.
Yeah, right.
Our connection's pretty good.
Mandeep, fourth quarter Gemini app monthly active users, 750 million. Mm-hmm. The estimate was for 650 million monthly active users. what does that exactly measure? Is that people using the standalone Gemini app, or is that me who's never used that app and instead just using mobile Google search, but Gemini within Google search?
No, so they do bundle Gemini with their Google One subscriptions. So if you're a paid user, then you could buy their bundle where they will sell you cloud storage and other things as well. But these are standalone Gemini users. And
so we should look at this as compared to monthly active users for ChatGPT.
Yeah, 900 million versus 750.
What do we know about people who use Google's products the way that I use them, which is like, recently I started using ChatGPT and Claude less because I've realized that the AI function within Google search has gotten pretty good.
Yeah,
when you look at it from like an LLM perspective.
And they just released this personalized intelligence, which basically connects their family of apps, Gmail, Google search, Chrome usage to Gemini. So they can personalize a lot of things for you than just, you searching based on a prompt, which is what you're doing on ChatGPT. And that's the advantage that Google has, is their family of apps. And that's why Meta is really building their AI data center capacity, because if you want a personalized agent, you want to give them, the context around what you're doing and how you're spending your time. And Google knows that because of Gmail, because of YouTube, and all the family of apps they have.
Let's just remind everybody where we are. Alphabet blowing past investor expectations when it comes to AI spending. Reported fourth quarter revenue too that beat expectations.
Not typically a good thing.
No,
blow past those expectations.
Yeah, the Google parent saying it will spend 175 to 185 billion dollars this year, compared with the 119.5 billion that analysts had expected. Fourth quarter sales, excluding partner payouts, were 97.23 billion, surpassing the 95.2 billion expected on average. We want to bring also into the conversation Dan Ives, global head of tech research over at Wedbush Securities. He also has the Dan Ives Wedbush AI Revolution ETF. Alphabet, by the way, is the fund's third biggest holding. Dan is with us from Miami. Good to have you here, Dan, with Tim and Mandeep. Your reaction to Alphabet?
Look, I think it's just further, solidifies what's happened in this AI revolution. Look at the spending, look at the monetization, and look, it goes back to look at this tech earnings season. Palantir, look at hyperscalers last week, as Mandeep talked about. I think to some extent, in terms of like this white knuckle, this nervousness that we're seeing, it just further solidifies the spending, the monetization, the cloud, the moves that enterprises are making.
Is this how great, in your view, is this increased capex versus expectations for NVIDIA and Broadcom?
It speaks to a narrative that we saw with Microsoft, that we've seen with Meta, we've seen across the board. It just further speaks to this arms race that's playing out across AI. And then when it comes to capex, look, obviously AMD stock sold off, but again, this is like Rome wasn't built in a day. You got to think about this is multiple years, 3-4 trillion that's going to be spent. And I think that's the one thing where, and I've seen it being at CS, being in Davos, Mandeep and I were there. The spending is unlike anything I've ever seen, going back to late 90s in terms of spending.
Everybody says these guys have to spend, these hyperscalers, right, in order to compete. Is there some truth to that?
In the case of Alphabet, not only have they trained their own model, but the Anthropic's model is trained on Google GPUs. And now you have got Apple saying they will use Google's chips. So 3 out of the big players are, we talk about applications and how good Alphabet is in search. This is about their chip prowess. And, the fact that 3 frontier labs or companies are using Google's chips, that's a testament to their mode and how well they have integrated vertically. And the Apple thing is huge, I think. That's why they are really ramping up the capex here.
Right.
Because they can see the demand just from one company. I mean, imagine if Apple wants to roll out Siri powered by Google.
I mean, that's what they're relying on, right?
I do think there is a lot of embedded business that's coming from Apple in that CapEx guide.
Mandeep, you were doing some multitasking. You were looking at your terminal. What else sticks out to you from this print?
Well,
what are we missing?
I think after the Microsoft print, I thought maybe, there were concerns around the cloud growth, and Microsoft talked about allocating some of their capacity to first party. This is a supply constrained environment, and everyone is trying to be very careful how they allocate that capacity. Every hyperscaler has that challenge, and that's where an Alphabet really is going big, because they have $150 billion in free cash flow. They can afford to go up to $180 billion in terms of capex. Companies that don't have that operational cash flow, they are the ones who have to think about, okay, how much do I raise my capex? But Alphabet has that $150 billion operating cash flow.
Do you have a calculation, Mandeep, for how much of the infrastructure spend a company like Alphabet uses for its own services versus selling to third parties?
I mean, you can model it based on the cloud revenues that they are generating, and that cloud business is close to a $70 billion run rate business.
Fourth quarter
now.
Cloud revenue, $17.66 billion, beating estimates of $16.2.
Yeah, so $70 billion annual run rate. Compare that to an Azure, which is a $100 billion plus run rate. So,
wow.
And you can see all these companies were spending capex close to each other. Microsoft obviously was spending more because they had that OpenAI partnership, but I mean, I would say 30 to 40% capacity in the case of Alphabet is getting allocated to cloud. And they are using a lot for AI overviews and their internal family of apps. And then the training component is huge when it comes to these LLMs as well.
That's Bloomberg Intelligence Senior Global Head of Technology Research, Mandeep Singh, and Dan Ives, Global Head of Tech Research at Wedbush Securities. They reacted just as earnings were crossing.
We should point out that conversation you just heard was as the numbers from Alphabet were crossing the Bloomberg terminal. The stock was kicking around. It sold off a lot initially. Then we saw it rally a little bit. And as the call went underway with the C-suite over at Alphabet, the company's CEO, Sundar Pichai, said Alphabet continued to demonstrate momentum in its cloud and search advertising businesses. Backlog for the cloud business, or revenue under contract but not yet booked, more than doubled year over year, reaching $240 billion, again, according to Sundar Pichai on the company's call. But I got to say, Tim, investors still a little bit spooked by that CapEx number. You can read more all about Alphabet's results. Just check out the Bloomberg or Bloomberg.com. You are listening to Bloomberg Business Week. Coming up, there's the AI build by Alphabet and many others. You know about that. There's also, though, the race to stockpile critical minerals.
The White House ponying up billions of dollars to do that. That's next. This is Bloomberg.
You're listening to the Bloomberg Business Week Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
This past week, President Trump announced plans to create a strategic critical mineral stockpile with $12 billion in seed money, a bid to insulate manufacturers from supply shocks as the U.S. works to slash its reliance on Chinese rare earths and other metals.
The plan, it's dubbed Project Vault, would combine $1.67 billion of private capital with a $10 billion loan from the U.S. Export-Import Bank to procure and store minerals for automakers, tech companies, and other manufacturers.
Now, critical minerals span everything from aluminum to zinc, but its smaller niche markets, such as rare earths, is where federal buying is more likely to move prices and impact trade flows. We caught up with Bloomberg News economic statecraft reporter Joe Doe to break down the key goals of Project Vault.
They're launching a $12 billion fund of sorts to purchase critical minerals to put into a strategic stockpile that is specifically available to U.S. private companies. We've had a national defense stockpile on critical minerals, rare earths, held by the Pentagon for decades, and we use that for obvious concerns of the case that a massive war breaks out and that suddenly we'd be cut off from supplies abroad. But there hasn't been anything specific to private companies. one of the reasons we're getting here is because we obviously had a long discussion about export controls for the past year that China in particular put on a number of rare earths. And I think that was the kind of question that has started to enter the mindset of the administration and why we're looking at a project like this now.
Hey, Joe, is this kind of akin to something like the SPR, the Strategic Petroleum Reserve? Yeah. Okay, it is. And I want...
Yeah.
Go ahead. But not like the Strategic Bitcoin Reserve, truly.
Yeah.
I'm serious. Well, I think the critics would out there say, hey, there's no use. We can use the SPR. We can use critical minerals. But we can't use Bitcoin. And that's a serious issue.
I think on some level, this is the way that folks at the White House have been looking around it, which is that you have the equivalent in critical minerals of the SPR.
For an investing audience who's listening and watching right now, does that mean basically the U.S. is saying, we're going to support you guys, at least in this administration?
Yeah, I think you have this seed money, right? There's about $1.6 billion that's private capital, alongside this $10 billion that's going to be from a loan from the Export-Import Bank in the United States. And we've seen some of this before, right? Where it's like you see that there's private money that comes in alongside federal money. The idea being that, okay, if the federal government is sitting here and backing a project, then it makes sense for private investors to say, okay, it's worth it for us to come in too. As I understand it, right out of the gates, they intend to start purchasing critical minerals. How does that happen? Well, an important part of this is the administration is apparently in this initiative already signed up more than a dozen OEMs, right? Just like actual consumers of critical minerals. You have Stellantis, Boeing, GM, or some other ones we've reported that have already been brought onto this partnership. Presumably, they will be the ones indicating to the vault, here are the critical minerals that our industries need, right? So automotive or aerospace or other industrial sectors. And then they take the direction from industry of what they should have in this stockpile and begin to go out and buy. So how long does all that buying take? I don't know. I think that's a detail that we're going to have to get from the administration. I've heard the idea that there's not too much a concern that they can go out and actually spend a lot of this $12 billion very quickly to build up this stockpile as quickly as possible. But again, things sound easier than they actually are when you have to actually go out into the market and start acquiring these materials.
Acquire them. Do they acquire them as raw materials, or do they acquire them as processed materials, Joe? And given that capacity in some of these cases to process these is absolutely dominated by China, how does the U.S. even fill the vault?
As we understand it, it is critical minerals, which could mean anything on the critical minerals list as deemed by the United States Geological Survey. So rare earths are on there, copper's on there, a number of other major metals are on there. What I think one of the things the market does need to understand is are we talking about raw ore? Are we talking about concentrates? Are we talking about refined metal? And then, listen, people are even asking wait, will this eventually include derivative products? Our reporting right now says that it is strictly to critical minerals, but these are things that the market's going to have to find out from the administration.
Can we assume that this is not just a Trump administration thing? Can we assume that this emphasis and whatever is set up today is going to continue into whoever is in the White House following Donald Trump?
Carol, you're asking a question that goes beyond a question that should be asked of just this strategic stockpile, right? It should go to the equity investments and the grants and the loans being given out to companies and everything else that the United States federal government's gotten its hand into. And this is a conversation I have every week with people asking, well, what does all of this mean when Donald Trump leaves office? I don't have an answer. And I don't think even the smartest people who are on the inside of all these things truly can give a firm response on what that means.
That was Bloomberg News economic statecraft reporter Joe Doe.
All right, from rare minerals to precious metals. Gold and silver both saw dramatic drops to start the week, down from an all-time high at the end of January. Now, this week's volatility extended to cryptocurrency as well. People were making some connections between both. Got to point that out, Tim.
In a Substack post this week, Michael Burry of Big Short fame argued that the original cryptocurrency, Bitcoin, which has fallen 40% since peaking in October, has been exposed as a purely speculative asset, failing to take off as a debasement hedge similar to precious metals. Further losses, he argued, could rapidly strain the balance sheets of major holders, force selling across the crypto ecosystem, and trigger widespread value destruction.
Hey, Axel Merck, he is president and chief investment officer of Merck Investments. He weighed in on the relationship between cryptocurrency and precious metals. This is something Michael Burry wrote about in his Substack post. And Axel also talked about whether he sees that as a potential risk as Bitcoin continues its downward plunge.
Just for the record, we also caution about the financial crisis. It wasn't just Michael.
You're right. Well, then you are the perfect person on many levels. But first, I want to ask you about AUM, because as we were prepping early this morning on our show call, your AUM has soared. Is that just because of the rise in gold prices, or is that about new investment money coming in? Because that's quite a jump in 1 year.
It's both. We have one product that's an open-end product. We've had inflows and the price of gold has appreciated substantially. The other one is a closed-end product and it's all internal performance. So both, it's just a sign of the environment that we're in, right? We've been talking about this, and views that have been on the fringes are moving more towards mainstream, and this market isn't so huge. And so you have some outsized returns.
How much, though, are the flows increasing? I'm curious, how much of it is flows? How much is it a price appreciation?
Much of it is appreciation.
Okay.
Very notable. We had some significant inflows at the end of last week when we had this downdraft. And this was one of the signs that the long-term investor considered this a buying opportunity. I'm not going to predict what the price of gold is going to do tomorrow, but we clearly had some outstanding returns on the upside, but there seem to be cooler heads in some places, and we tend to attract a more long-term investor. Let's keep that in mind as well. The speculators tend to go to other products.
So let's get to your warning and also to Michael Burry's warning. The interesting part that we're pointing out from the Michael Burry piece on the Bloomberg terminal, he's warning that Bitcoin's plunge could deepen into a self-reinforcing, quote, death spiral, inflicting lasting damage on companies that have spent the past year stockpiling the token. He argues that Bitcoin has been exposed as a purely speculative asset, failing to take off as a debasement hedge similar to precious metals. He cited the fall in the crypto as particularly to blame for the recent collapse in gold and silver, as corporate treasurers and speculators needed to de-risk by selling profitable positions in tokenized gold and silver futures. Do you agree with that assessment and that connection between silver and gold and Bitcoin?
Well, some of it. Clearly, when, quote unquote, everything is levered and you have a deleveraging going on, quote unquote, everything is coming down. The one thing I framed Bitcoin as something that still wants to decide what it wants to be when it grows up. And part of the reason why I've said that is that unlike gold, crypto has consistently been highly correlated with risk asset, with the S&P 500. So when risk is off, when the S&P goes down, crypto goes down. Obviously not every day, but quite a bit consistently. Whereas precious metals have a long-term correlation of zero towards risk assets, correlation phases in and out. And so sure, in a downdraft, when there are speculators in gold or silver, it can be taken down. But I think gold has shown that it has a different dynamic. And so, but at the other end of the spectrum, sure, if Bitcoin continues to plunge, those who have levered up on crypto, including those special purpose companies, they can suffer disproportionately, to put it kindly.
But the impact on these tokenized gold and silver futures, I mean, a small role in the pullback, or is it just a case of gold and silver, Axel, running up so much, and so a pullback of some sorts was to be expected?
Well, when a product is based on derivatives, and a lot of attention has been focused on this Chinese silver ETF, the Chinese don't have many investment options, and so they tend to pile into a product. And when that product is based on derivatives, it's a recipe for disaster. In the US, we have margin requirements. They tend to increase when volatility goes up. That's a healthy mechanism for correction. Remember, the purpose of these rules, be that from the regulator, from exchange, is not to prevent you from making a stupid decision, but that your stupid decision doesn't wreck the system as a whole. And so I mentioned that because the fallout is limited if the system is well designed. Now, clearly on the crypto side, there are a lot of unregulated products, but we've seen a natural selection there. And so, yes, there may be some spillover because the speculator might be active in one more than one area. And last year, speculators have kind of gotten back to precious metals where they used to be before they were meme stocks. But overall, I think we see it unfold here, right? There's increased volatility, but gold bounced back. We are just around 5,000. And so that's much healthier than on the crypto side where the animal spirits are the beginning and the end of everything.
You said that Bitcoin is still trying to figure out what it wants to be when it grows up. Is this proof that it is not digital gold?
Well, it's different. It's clearly different. I think there's amazing value in the underlying technology, but Bitcoin themselves remains to be seen. Now, clearly, I know all the arguments that are in favor of it, and at the end of the day, though, it is about mass psychology, and the track record of Bitcoin is just very short. And I'm not saying that the dynamics cannot change over time once it gets more mature, but for the time being, the jury is very clear that it is a risk asset, whereas gold is a defensive asset. And defensive has to be taken with a grain of salt, of course, because it's also very volatile, but the dynamics are very, very distinct, and as such, I think they attract different investors. But clearly there is this tension between the two groups, and it's good that there's a choice for investors ultimately, right?
That was Axel Merck, President and Chief Investment Officer of Merck Investments.
Still ahead on Bloomberg Business Week, Connect One Bancorp's CEO on why investors are paying attention to the banking sector.
This is Bloomberg.
This is the Bloomberg Business Week Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Investors have been rotating out of the bigger national banks and into the smaller and medium regional lenders this year. The KBW Regional Index rose more than 7% in January, outpacing about a 2% bump in the KBW Bank Index of big banks.
We spoke with the head of one regional bank, the CEO of the New Jersey-based Connect One Bank, Frank Sorrentino. The bank has a $1.4 billion market cap. It's up about 7% so far this year. And we really want to talk to him about today's environment.
Doing great. 26 is a great year ahead of us. I really believe. A lot of people said, survive till 25. Well, here we are. It's 2026, and things are looking really up. So very confident about what's happening.
Well, as Carol mentioned, it's not just that you guys betting on the U.S. Spain's largest bank betting big on the U.S. We already have foreign banks here. What's your view on the deal? What's the competitive landscape for the U.S. and like for business?
Look, there's a lot of consolidation going on in the U.S. markets for financial institutions. The United States is a sort of a rare breed across the globe where we have some 4,300 banks today, which you don't find in most countries. And so there's a natural consolidation going on. We have a very, very accommodative administration and regulatory agencies that are allowing for some of those M&A activities to take place. And, notwithstanding what everyone would like to say about the U.S. and all the headlines and whatnot, there's a lot of foreign capital that wants to find its way into the United States. And so when you see a deal like this that you just announced, clearly that's foreign capital moving to make an investment here in the United States. For banks like Connect One that are in the market in the region that Webster was in or is in, we see that as a boon for us.
Why?
Well, anytime there's consolidation like that or a merger, clients get impacted. The ability to do certain types of loans may go away. Certain products get phased out or whatnot. There's a lot of turmoil in that wake, and so generally smaller banks are there to pick up the pieces. And so we're excited to see this transaction take place.
We've asked you in the past about M&A, mostly from the perspective of you going out and buying other banks. What about bigger banks coming knocking on your door? Does that happen?
Listen, it's always I've said to our investors, our everyone, where our job is to continue to make ourselves unavailable to be sold, but certainly that's always a possibility for every institution, and it should be for every company, right? It forces you to run your company in the best way possible. But certainly there's always that opportunity out there.
Did you say availability to be sold?
Always, every company should look at their business plan and their model, looking at what value. If you want to talk about a value of a company,
right?
The value is what someone's willing to pay you for it, right?
Right.
So how do you set the company up to be the most profitable, the best company in your market in the products that you provide? And if that's true, there'll always be someone interested in an acquisition.
But sometimes you have to spend money, right, to do a strategy that pays off longer term.
When I say profitable, it may not be financial profitability.
Okay.
Are we creating value?
Yeah.
And so, one of the things I'm the most proud of, we've been at Connect One 21 years with pretty much the same management team, and we've created an enormous amount of value over those 21 years, and no one's been able to buy us.
Not yet.
So, that's right.
But you're open to it.
As I said, I think everyone should be open to that.
We were talking with our team here.
By the way, you just saw it in the transaction with Webster, right? That was a fantastic company, well run, well managed, great markets, and someone offered them, a price they just could not refuse.
I mean, what's fascinating, I think, around us, we used to have a bunch of retail, and then they left. And 2 banks have opened up. Citibank across from us, and is it Capital One? That's like downstairs. A cafe and so on and so forth. It's not retail that's coming in. I just feel like banks are popping up. I mean, banking has been a pretty good business for a while, especially the last couple of years, it feels like.
And I think it will continue to be.
And is it because of the consolidation, or is it?
Well, that's part of it.
What is it that's really juicing it?
Look, part of it certainly, if you have less banks, it's you're going to first off you're going to have bigger banks that have bigger balance sheets and the ability to provide better products and services, and that's more desirable. We're also seeing, at the ground floor, all of our clients are getting bigger and smarter and more sophisticated, and so they have needs for more financial products. So, not to dismiss, the small community bank that doesn't have a lot of that product and service set, but what we see here, certainly in the New York metro market, our clients are getting larger, they're getting bigger, they're entertaining M&A, and so they're leapfrogging in size. And so they need a bank that can continue to service their needs. And so part of our growth strategy, it's, we want to create value and we want to grow our earnings and all that other stuff. But I also recognize if we're not growing Connect One, we're not going to be able to satisfy our clients' needs as they're growing. And to me, that's an incredibly important part of our organization.
One of the reasons we like to talk to you is because you have a great view on small business, specifically on construction, on builders. That's sort of the DNA of your bank. You've been really consistently, quarter after quarter, at least with us, optimistic about that demographic that you serve. Does that optimism remain today?
Yeah, nothing's really changed in my view, and through the clientele that we have relative to it, when we talk specifically about construction and probably in multifamily and industrial warehouse and manufacturing in those areas. There's just not enough product on the market. And when it comes to, apartments and homes and condos, we are so woefully short, specifically here in the New York metro market, that I don't think you could build enough to satisfy that in any short period of time. So to say I'm optimistic would be an understatement.
Well, what do you make of the story? I mean, we were watching home builders on the move this week, and this is, was it Lennar, and I forget who else, that has apparently approached the administration about building affordable homes. They call them Trump homes, including private investors. It sounds like there's a lot of details to be worked out. I don't know. How are you viewing something like that? Does this kind of make sense as maybe a first step to figuring out a strategy, or does it? I don't know.
Yeah, so the answer is yes. It's a great idea to think about affordability first, relative to, new homes, home ownership.
And it's rent to buy, I think is the strategy.
Home ownership is great, all these other things. Yeah. But, the real impediment and the reason why we don't have enough homes today is not because of capital and it's not because of bank lending. There's political change that has sort of crept into the system. You just can't build. You have to, between environmental issues and, the parochial town by town issues, zoning issues, insurance needs, whatever it is, creating this environment where it's just difficult to build. So unleash the ability for builders to build, and you'll have affordable housing.
You guys are talking about housing, and you got me thinking about infrastructure, and maybe it's because we're seeing this right now in the midst of a sort of unprecedented or historic freezing weather here in New York and challenges that are associated with that. But you've got a lot of big players betting big on infrastructure right now. Are you able to play in infrastructure at all?
Most of it's bigger than what we can manage, but I would agree that there is so much need for infrastructure build. You drive on any road, go across any bridge. It's really, I use the subway often here in New York. I mean, there's clearly a need for infrastructure spending just about everywhere.
But it's right now that's a little too big of a swing.
Generally,
for you to
those
take.
things are
Okay.
they're beyond our balance sheet capabilities.
We've been talking kind of macro and big.
But hold on, but however.
Yeah.
All of that infrastructure, I'm excited. That's part of my speech too. That all that infrastructure capital that's coming in, when they repave the turnpike or they build a new section to the subway or build any of these products. Think about it. They all need shovels. The workers all have to go to the deli.
Yeah.
They all need their clothes cleaned. They all need to buy shoes, and those are all the businesses that Connect One supports.
It's economic velocity,
infrastructure,
right?
Yeah, infrastructure spending is great for the economy.
All right. What about President Trump's new choice of a Fed chair? Will he be potentially great for the U.S. economy?
Look, he's an interesting choice based on what everyone expected. I think he's the exact opposite of what everyone expected would actually happen. And if you look at his history and what he's focused on, the thing that I like the most is that he is data driven. And I've said those words on this show often. I think the Fed needs to look at the data and make decisions about what they're going to do with our money supply. You've heard me speak many times on this show about that interest rates maybe aren't the most important thing we need to be focused on, but the Fed balance sheet is. And very few people want to talk about that. He wants to talk about that, and he is saying that Fed balance sheet is too big. It needs to be reined in. It is causing market distortions, and really interest rates can afford to be lower if we get the Fed balance sheet under control. And I happen to absolutely agree with that position.
That's Frank Sorrentino, founder, chairman, and CEO of the New Jersey-based Connect One Bank.
I have to say, this is a voice we love to lean on for a lot of different reasons. Yes, the lending environment when it comes to individuals and certainly to businesses, but he just kind of gives us a very real perspective on things. I feel like never afraid to say things. And he even admitted, as we heard in the conversation, that last year he was very optimistic, and that was a bit of a contrarian view considering all of the volatility. But his optimism feels even more confident this year.
Yeah, and it comes from a place of really understanding what these small businesses and what these construction companies and these contractors that he lends to are doing and seeing in the environment. It's one of the reasons we like talking to him, because he does have exposure to that group of clientele that really is putting shovels in the ground and spending money on building.
Yeah, I also love whether it's affordability in terms of housing, whether it's artificial intelligence, talking about, kind of his real view about kind of watching how this stuff is evolving and what needs to be done to either protect us in a world of AI and also how do we really get to affordable housing. And that wraps up the first hour of the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Coming up in the next 60 minutes with the Winter Olympic Games underway, we take note of host Italy firing up snow cannons for alpine skiers and really what Olympic cities in the future and really some closer to home already are doing to keep the snow coming.
Plus, the CEO of Brooks Running on the business and the consumer. It's a Berkshire Hathaway company. And a check of small business, the head of Hoboken Farms on going from farm to your table.
This is Bloomberg Businessweek. I'm Carol Massar.
And I'm Tim Stenovec. Stay with us. Today's top stories and global business headlines are coming up right now.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek. Well, the Olympics, they are underway in Italy. And for the Winter Games generally, we are seeing warmer temperatures, and that is posing issues for host countries. They are making multi-million-dollar investments in sophisticated snowmaking systems to create and maintain optimal surfaces in hopes of avoiding even costlier cancellations or relocations of races.
We'll hear about some systems that are being used to make snow here at home in the U.S., plus how a family-owned business that started as a farmer's market grew into a national company that sells pasta and tomato sauce all across the country.
First up this hour, a look at the consumer and the ever-popular world of athleisure and workout clothing and sneakers, to be quite honest. We do that with the CEO of Brooks, Dan Sheridan.
Hi, Carol. Thanks for having me back. Happy to be here.
It's great to have you here with Tim and me. Lots to get to. We're going to get to it. I got to say, with the backdrop of markets, though, and some nervousness out there, and Bitcoin's continued slide, I got to ask you about the macro. And I got to ask you, does anyone buy your sneakers with Bitcoin or crypto?
I think if they do, it's a very small percentage. You know, I think for us, we just finished our 2025 year and we grew 16%. So our consumer is very, very healthy right now. And it's rooted in the participation, which we've talked about in the past. More people around the world are running and walking, and Brooks is winning the runner at the cash register. And so our consumer is holding up.
We talked with you back in October. It was just ahead of the marathon here in New York City. Curious how your world has changed since then. What can you tell us about changes in consumer demand since then? Supply chain improvements or supply chain changes? The business outlook? What has changed in a few months?
Yeah, well, I think you always start with the consumer, and our consumer is very resilient. You know, we compete in maybe the most competitive category in sporting goods. We're the number one brand there. And what we're seeing at the consumer level is because running is so important in their life, they trade off on other discretionary items. But the shoe and apparel always wins because it's so important in their life. And we're seeing it around the world, Tim. The consumer is very, very strong in our category. Our EMEA business was up over 20%. Our Asia business growing really, really nicely for us. And so it's not just a U.S. story here. It truly is a global story for us, and we're winning. You know, in terms of supply chain, we've seen it somewhat normalize over the last, call it 4 or 5 months. We had a lot of tension in the trade discussions, and we've got our arms around that. But I would tell you it's stabilized for us in our category.
Well, you know, and I do wonder, so in terms of tariff concerns, global supply chains, things have settled down, and you feel like where they are, they will stay that way for the next couple of years?
Yeah, we're hopeful. I mean, based on the signals that we track, we think we're in a solid spot right now. Now, what we know is that things are changing rapidly in terms of the discussion with the administration. But for our category, we have high tariffs. I think last time we were on, we talked about it. Our tariffs are extremely high for this category, and so we went to work on that through the whole value chain to get our arms around it. We're going to see some compression in terms of profitability, but in terms of the long-term vision, we think we've got our arms around it, and we'll continue to monitor.
Hey, I want to talk a little bit about China because in the fall, you told our Bloomberg News team that you were going to make a big investment in the next few years, 30 stores in China by 2027. China sales in 2025 for your company up 245%. At the same time, Nike, Adidas, Lululemon, they've been struggling in China. What are you doing differently?
Yeah, again, it starts with the consumer. And what we know about the Chinese consumer is as the middle class is growing, this is the perfect time for a brand like Brooks to enter. We deliver fantastic performance product consistently over time. We have a brand energy that resonates with the Chinese runner, and we're engaging in the communities that are part of the run community over there. And so the store is central to that in China. And so our rollout of stores is a big part of this, but we're having a lot of success online with those running communities, and we're new entry into China. So the growth we're experiencing is incredible, And it's just a testament to how we enter markets and how we execute. Our team is executing really, really well over there.
It does sound really good. And I am curious about longer term future plans. You are obviously part of the Berkshire universe and have been for a while. Would you guys ever consider maybe an acquisition to expand into some of the adjacent categories? Talk to us about kind of expansion and strategy plans. And we're also always curious, like, could you guys go public at some point? Or do you think that you're going to stay within the Berkshire homestead for a while? More.
Boy, Carol, I hope we stay forever with Berkshire, and I believe we will. The biggest advantage we have at an ownership structure is Berkshire Hathaway. I talked to you about this last time. We're so fortunate to be owned by Berkshire, and more importantly, I as a CEO have a very long time horizon that I focus on because of our ownership, and that's a benefit to us in every decision we make. And so ownership matters in business. We're lucky and fortunate to have the ownership of Berkshire Hathaway, and we continue to take a long-term approach to this strategy. When we enter markets like China, like in Europe, and the exposure that we have there and the growth that we have there, the fact that we can focus on 10 and 20-year horizons here is very different than our competition, and I don't take that for granted.
That's actually very Chinese, if you think about it in terms of strategy.
Last time we spoke with you, Warren Buffett was still at the helm of Berkshire Hathaway. Now it's Greg Abel. How is that going so far? How does his leadership compare to Buffett's? What's he like? What are his priorities? What has your contact with him been?
Yeah, I would tell you the word that comes to mind is consistent. It's consistent with the culture of deserved trust and empowerment. Greg has always led with that. It's consistent with in terms of how they think of the subsidiaries. And so Greg is a very consistent manager and will remain that for us. I believe that. I had a unique opportunity in December to travel to Omaha and spend some time with both Greg and Warren, and now Adam Johnson, who's now leading our division. And I could tell you that the same things are true throughout the leadership at Berkshire, and what an advantage for Brooks.
Hey, one of the things, and we're talking with Dan Sheridan, CEO of Brooks Running, joining us from Seattle, Washington. Dan, we talked about the Chinese consumer, and sounds like things are going really well. I would love to know, what is the breakdown between Europe, China, the U.S.? And I want to just, if we can kind of drill down a little bit more into how the U.S. consumer is doing.
Yeah. So for our business, Carol, the U.S. is our largest region.
Right.
About 80% of our global revenue comes out of the U.S. And that's why it's so exciting for us in terms of the growth that we see ahead. We are very meaningful in the European market. We're the number one brand in Germany now in performance run. It's been a 10-year vision of ours to achieve that. And as I said, we're just getting started in China. So when we look at the total addressable market, it's a $48 billion market in terms of run. And where we invest is in the top countries where running is exploding. And so the markets that we're set up in are the ones that we're investing in. And Western Europe's a big investment. China's a big investment. Mm-hmm. And as I said, the consumer's super healthy there. It's rooted in participation. What we track are participation metrics. In the U.S., there's about 50 million runners that run twice a week. We think globally that's close to 200 million people that are choosing this activity, and Brooks is winning with that consumer. So the consumer is super healthy.
So on the consumer and the consumer choosing Brooks, why are they choosing Brooks from a technological perspective rather than a competitor such as Hoka or Nike? So what is the differentiator with Brooks Running's technology?
I love the question, Tim. This is why we exist. We're a product company first and foremost. And so innovation for the runner is why we win every single day. We spend hours, months, years researching the biomechanics of human motion. We are in the business of keeping people healthy, running farther, faster, longer, and we've been able to do that consistently. We're in our 25th year of 14% compounded annual growth because of the position we have in products. So we win first and foremost in product. The second thing is we execute really well as a business. As you can imagine, global supply chains. We sell in over 55 countries around the world. We have developed a supply chain and an operation excellence that we think wins in every market. And that's not easy to do. That's the really hard part. And then this brand speaks to runners. We're an authentic, relevant brand that understands the journey of runners around the world. So when they're looking for a brand, they find authenticity in our brand. And that combination works in every market we've gone into. And so we often say we study our competition, but we really obsess on the consumer. And we've been able to stay ahead of the consumer in product, in execution, and with our brand ethos of let's run there. And it's working in every market we're competing in.
That's Dan Sheridan, CEO of Brooks Running.
You're listening to Bloomberg Business Week. Coming up, the farmers market stand that grew into a pasta and tomato sauce business selling food all across the United States.
The head of Hoboken Farms with a great read on the backbone of the U.S. economy, small business. This is Bloomberg.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So when we can, we really like to step away from the barrage of headlines that are important and yet sometimes distract from understanding the U.S. economy at its core. And at that core, we mean the individuals who run small businesses, the backbone of the U.S. economy.
According to the U.S. Small Business Administration, the U.S. has more than 36 million small businesses, and those businesses provide close to 46% of employment in the private sector. And our conversation with Brad Finkel covers exactly that. He's CEO of Hoboken Farms. It's a family-owned company. It started out as a local farmer's market. It's grown into a business that sells pasta and sauces all over the country.
I have known you a long time, and I want to get into how you've gone from farmers markets to so much more.
Sure.
But I want to also ask you, because you guys, I've been to your, bought from your different stands and so on.
Hamilton Park, Jersey City.
I have. And so you guys have people out in front talking with consumers all the time. How would you say the consumer's doing right now?
I think the consumer is scared. I think the consumer is confused. I think the consumer is trying to grab onto some form of an idea of what they can plan for, and they can't find it.
So being more discretionary in spending? Do you see that?
Well, in my exact world, I find consumers are not going out to eat to restaurants as much. They are cooking at home, so they're coming to us, but they certainly want unbelievably high quality, and they also want value for their money.
I see that too. People aren't ordering food as much here in New York City. They're not getting delivery as much.
We're definitely not doing that.
I've talked to some folks about this for a couple of reasons. One, the prices have, with all the fees added on, have become incredibly high. So I think people are cooking more at home. Is this how is this moment different from other moments that you've sort of experienced being in this space? I know that your business has grown a lot in recent years, but you've had a good eye on the consumer for quite a long time.
I started my business in 1992.
Yeah.
We participate in up to 800 farm markets a year. That's outdoors, underneath tents, on the street, face to face with our consumers. In 2001, we were there during 9/11. Then during the recession, we went through that. This feels kind of like a combination of both. Not just confusion, but fear.
This is such a different message than we're getting from the executives of big companies.
Yeah, who seem to be still upbeat about a lot of things.
Well, I mean, if you're an investor, that's great. But if you're trying to feed your family and you're not going to restaurants anymore and you're going to supermarkets, and if not supermarkets, farm markets.
This is why I've loved talking to you over the years. You've also been a real estate investor. You've sold businesses. But it's what really matters when it comes to small businesses. Is it changes in the administration? Is it any of that stuff?
Far be it for me to be able to say what matters. But what matters to me is stability. If I'm going to plan for next month, next year, I have to be able to have an understanding of what it is I'm planning for. I mean, for instance, our pasta sauce is, popping up on shelves across the supermarkets of America. Tariffs hit.
our ingredients, our COGS go up. What do you do about that? So as a small business, it is something that hits our pocketbook. Last night, I just read a posting from a really well-known restaurant that is closing its doors. Wow. And it was really like, I cannot do this anymore. It is just a horrendous place in the country to be able to do,
we saw that during COVID. We were shocked by how many even like very well-known chefs and restaurateurs who were struggling, and we thought they would be good. We want to get to your story because farmers market is where you began. You have tons of farmers markets, and you're doing it in crazy weather and even this weekend in the cold. How do you get to where you've got multiple not brands, but jars of sauces, different things, and you've become a much bigger business. You're in a ton of stores around the country. And tell me if I'm wrong, because my daughter said, I think I bought them in London.
We do have a couple of places in London that you can buy it at. Smaller, independent. In fact, we just got an order from Ireland today, and the tariffs affected. Now all of a sudden, there's a lot more hoops that we have to jump through. So I was a teenager living in Hoboken, New Jersey, playing bass in a band, in a van, touring from Hoboken to Maine, down to Virginia, to Memphis, to Nashville, into Austin, Texas. And as you could imagine, that is not a great plan for financial stability. So I was going to Ramapo College in Mahwah, New Jersey, up Route 17, and I would meet these nice kids who weren't from Hoboken, and they would say, would you like to come over from my house? And I said, yes, and then I would get a phone call. Hey, my mother wants to know, could you bring some mozzarella? Sure. My father wants to know, could you bring some baguettes from Dom's Bakery at 6th and Grand? Absolutely. And this kept on happening, and I said to my grandmother, do they not have bread and cheese where they live? But what it was in my sociology class that I heard about was the gentrification in Hoboken had started. These were ex-Hobokenites who had moved to the suburbs, and I started a home delivery service. Literally, if you called me and left a message on my old cassette answering machine on Monday, I delivered to you on Tuesday. If you called on Thursday, I delivered to you on Friday, and I ended up with a couple of hundred customers. One of those customers was a gentleman named Peter Baronio. Peter Baronio became the economic development director for Englewood, New Jersey, called me up and said, we're having a farm market, would you like to come? I said, what's a farm market? And he said, I don't know, but we're having one.
Isn't that crazy? Because they're everywhere now.
Well, now they are, but kind of started as a side hustle. I made a marinara sauce, and that marinara sauce really took off. Now, that's kind of the short story. People would stand online and buy it by the case. A very important buyer from Whole Foods saw that line of people, tried our sauce and called me up on a cell phone and said, we'd love to have you in our stores. And I said, which one? They said, all of them across the Northeast. So that started my journey from farm market to supermarkets across America.
We're speaking to Brad Finkel, founder and CEO of Hoboken Farms. Here in the studio, you brought a selection of what you do offer. It includes pasta and sauces. How have you been able to keep the taste and the ingredients consistent as you've scaled and gotten bigger?
Oh, wow. We go.
Were you able to do that?
Well, we go to every run. We are there, so we're tasting tests, we're tasting color, we're tasting viscosity, we have sugar content. So if it does not meet those expectations, it gets donated to the Community Food Bank of New Jersey.
But I want to go back because I know this. You had mentioned to me that one of the reasons you got into sauce is your customers started asking for it. Because I've bought your ravioli, and people were like, can I get some sauce?
Right. So all day, every day, we sell now hundreds of thousands of loaves of bread and tons of mozzarella and burrata, countless coolers of ravioli, and people would come to us and say, do you have any sauce to go with that ravioli? Nope. Do you have any sauce to go with the pasta? I do not. And finally, a very Jersey guy, came over and said, hey, dummy, who are you standing next to? And I looked to my right, and there was Kurt Alstead from Alstead Farms, there was Dale from Stony Hill Farms, there was Matt from Cherry Grove Farms, there was Doug from Race Farms. Fellas, got to get some tomatoes and some basil, and we started making some sauce.
But you also mentioned that you have to get some ingredients from outside of the U.S.
olive oil. Yeah, I mean.
Okay.
Yeah.
So is that it? Is that everything else is from Jersey? Are you able to?
We do our very best. Our original ingredients came directly from the farm markets. We have to make sure that we have the best tomatoes, the best basil, the best onions.
What I think is
we sell a lot of sauce now.
What is so cool is, though, it's like you listen to the community, or the community says, do this. And then when you go to make sauce, you look around you and you embrace the community to do it.
Well, a farm market is both an ecosystem and an incubator, right? So it's an ecosystem.
Right.
I need tomatoes and basil, and there's tomatoes and basil.
Okay. Now I want to go to the community, because there's a point where you're growing the business and you got to think about financing and capital and raising capital. And again, I feel like the community kind of came to you.
Yeah, so we kind of have a 1 in a million raise story. It became obvious that the opportunities that were coming our way meant that I needed a bigger boat. So I was ready to kind of start going to institutional investors and, the Banks of America, and telling my story. When word got out to our customers, kind of through the grapevine, that we were contemplating this, some very savvy investors said, "Wait, we want to be part of this." They've invested in CPG products before, and I didn't have to do any of that.
We've only got about a minute left here, unfortunately.
And you've raised $4 million in Series A funding.
We have.
Okay.
So where do you go with this? IPO, sell it? What do you want to do?
No. We are building our business straight down 95, down south to the Midwest. We have Pavilions and Lassens in California. We have Jewel and Tony's and Pete's in Midwest, Central Market in Texas. We are growing our distribution, certainly also online as well, direct to consumer.
Do you plan to expand the products even more?
We have pizza sauce coming. We have a couple of other things, but we are a small but mighty group of experts. So I was able to get those economics to bring on expertise and better execution, and that's allowing us to scale across America.
That's why we like talking. It is the backbone of the U.S. economy. Brad Finkel, thank you so much.
Just a few days after we spoke with Brad, we got some new data from Challenger Gray and Christmas. This is the outplacement firm. And it noted that U.S. companies announced the largest number of job cuts for any January, going back to the depths of the Great Recession in 2009. And it's relevant to this conversation because he talked about consumers being more cautious.
Yeah, and it's interesting. Contract loss, economic conditions, and restructuring were the top 3 reasons for announced job cuts last month. That's according to that report. Almost half of the job cuts announced in January were tied to 3 companies: Amazon.com, United Parcel Service, and Dow. Amazon announcing plans to cut 16,000 corporate positions in a restructuring, while UPS said it would shed as many as 30,000. And Dow looking to eliminate about 4,500 positions, while Peloton Interactive and Nike also announced workforce reductions. Those are some of the big companies. But we know, as we always say, backbone of the U.S. economy, those small businesses. And as we heard from Brad, he's seeing from his consumer base that they've got to be really careful. So you could always, that kind of plays its way all the way into those running small businesses. They've got to be also careful too about the economy and what that means maybe for their future hiring.
Yeah, this figures add to signs of a fragile labor market characterized by limited numbers of overall dismissals and lackluster hiring. As you mentioned, Carol, these are some of the bigger companies. Curious how it hits smaller firms that are out there.
Yeah, something that we know the Fed is going to be watching. They just did their first meeting of 2026 last month, but that job mandate and whether or not we're at full employment and can kind of keep it there, or whether or not we're seeing some weakness. All right, still to come on Bloomberg Business Week, there's no snow. Why that could mean trouble for the Olympics of the future.
This is Bloomberg.
You're listening to the Bloomberg Business Week Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Thousands of athletes have descended upon northern Italy for the 2026 Olympic Games. Organizers of the Games breathed a sigh of relief when snow blanketed the Italian Alps throughout January. Unusually warm weather around the holidays had them worried the slopes wouldn't be ready in time. Alpine areas are heating up faster than the rest of the planet, with shorter winters that tend to bring less snowfall and more rain, plus bouts of extreme cold and poor visibility. The vast range of possible conditions and their increasing unpredictability makes planning for the quadrennial winter sporting event harder than ever before.
It's not just the Olympics. In the western U.S., resorts are increasingly seeking solutions to freshen up some brown slopes. Winter Park, operated by Vail rival Alterra Mountain Company, is one of a growing number of groups in the American West doubling down on something called cloud seeding, from state governments and ski hills to utilities and watershed management agencies.
Bloomberg senior correspondent Kyle Stock joins us now from Denver to talk about how ski towns are bringing in the snow. And I feel like I shouldn't be the one bringing you in. I really think Tim should, because he's the skier here. So Tim, take it away.
Okay, so Kyle, traditionally and historically, in order to get snow on slopes when it doesn't come from the sky, from natural sources, ski resorts have turned to snowmaking. As you write in a recent piece for Bloomberg News, that actually uses a lot of water. Nowadays, some resorts, including Winter Park, are doing something called cloud seeding. What exactly is it?
It's not that new of a practice. It's been around for decades. They take something called silver iodide, which is this tiny molecule. They blow it up into the sky or fly it in planes and drop it into clouds. And these are clouds that are wet enough and cold enough to make snow, but they just need a little nudge. So it acts as a catalyst. Basically, this little chemical acts as a tiny piece of ice, which, the water droplets attached to, like iron filings to a magnet, makes a snowflake, and you have fresh powder. That's the theory, at least. It's been around since the 60s, but it's something that people all over the West, ski resorts, watershed management groups, utilities are turning to increasingly.
It's been around since the 60s, as you mentioned, but one of the reasons why not everybody does it, in your piece you point out Vail stopped doing it a few years ago, is because it's not necessarily proven that it actually works in the wild. What did you find?
The main scientist on this is this woman, Katja Friedrich, who works at University of Colorado here. And I went to meet with her, and it was funny because she is like a rock star among cloud seeding heads. She's like the champ. She did this beautiful study in 2018 where she flew a plane through a cloud. She didn't fly the plane, but had the plane fly zigzag through a cloud, seeded the cloud, and there wasn't any snow except what fell in this zigzag pattern. So everyone points to that study like, hey, this is proof this works. But I went and met with her, and she said, yes, it works. It works in a lab. She's still not convinced it works to any appreciable degree. She says the environment is way too volatile. There's too many factors at play to prove yet that it creates, a substantial amount of snow beyond a dusting. So the science is still very much in question here. That's one of the things that is happening in the Western U.S. this year, this desperate push to validate this stuff, to get results, to get data, to show that it works in an appreciable way that makes a difference to someplace like a ski resort.
You also talk about state governments, watershed management agencies, utilities. I mean, people are thinking about, the need for water and water creation. I mean, people used to laugh years ago that, water was going to be the next commodity that we were going to be thinking about as an investment play because we just assume it's always going to be there. But here we are because of climate change. Going back to this cloud seeding, I guess, is part of the problem when they do this, they don't know how much of that would have snowed anyway. Like, what's the problem in kind of figuring out how effective this process is?
Yeah, just getting the results in an apples to apples basis. So, when you think of a cloud or a storm, this is huge. It's a huge meteorological event. There's lots of variables. There's winds. They send these particles up from the ground. They don't know if they even get in the cloud. They can be blown miles away. They get in the cloud. Does it snow there? Does it snow the next state over? It's a really turbulent environment. But if you talk to people like the folks at Winter Park, they're convinced it works. They try to do radar tests where they see where they're seeding, and they do the radar very close close by and compare and contrast the results. They'll seed one branch of a river and not the other and look at the water levels in the spring. They're very convinced, but in terms of, scientific rigor, it's a really hard problem to square.
So enter private companies that are trying.
You just want to get to the cool dude, don't
you? Augustus. Is it Augustus Dorico? So this is a company called Rainmaker. What are they doing?
Pretty novel. They thought, let's seed from a drone because it's cheap to seed from the ground. It's expensive to seed from an airplane, but that gets these chemicals right where they need to be in a cloud, right where they want them to be. They built these drones, they built these radar systems, they built a little weather site on each drone so they can fly these up into the cloud and theoretically get them right where the conditions are perfect, the temperature, the humidity, etc. Drop the chemicals there and have a more targeted approach, and still a relatively inexpensive way to do it. So they have about 100 drones around the American West this winter, which is really their first winter of doing this at scale. Most of them are in Utah. Policymakers have been super alarmed about water levels for years now. The state legislature really kicked up their spend on cloud seeding 3-4 years ago when the Great Salt Lake was at historic low levels. Everyone was really alarmed. Everyone's really aligned on this there. They're really on board. But the skeptics will say, people are desperate. They're going to try anything. Really interesting to see what kind of results Rainmaker publishes in the spring versus what we might have seen anyways.
Yeah, we and it sounds like kind of a guy we need to have on and talk to him. I'm curious about, and you too, because you know this world. What's the cost of doing this, using the drones, throwing them up in the air? And I'm curious about that. And I'm also, is there any ecological impact? I feel like there's never ever any free lunch, I feel like, when it comes to our environment right now.
Seeding from the ground is really cheap. It's basically, these units, they're kind of like large barbecues. It's just a propane fire and these chemicals. So in terms of ROI or bang for your buck, it's way cheaper than snowmaking. A lot of the policymakers I talked to said there's really no downside to doing this. The drones are a little more expensive. Utah is paying Rainmaker about $7.5 million this year. They have said, if this stuff works, that's a drop in the bucket. It's the smartest money we can spend. Ecologically, there's been some alarm about this in state governments, in Congress. The silver iodide is inorganic. It's naturally occurring. You could eat this stuff and it won't dissolve in your body. It's in the soil. It falls down in the snow melts, the stuff goes in the soil. From a chemical perspective, it doesn't seem to be that dangerous. There's some debate about whether the consequences are further downstream. Like if you're taking water out of a cloud in Colorado, are they seeing less precipitation in Kansas and Nebraska? Most of the science is pointing that that's not the case, that there's so much precipitation, there's so much humidity in these clouds, and it regenerates over time. So ecologically, the science seems to point to it being pretty zero consequence right now. It's kind of, most people say it's a win-win-win, but again, the science is evolving, so we'll see.
So Kyle, gets us to a point where cloud seeding, okay, if it works, it only addresses one part of the problem, and that's getting snow on ski mountains in cold environments. But it doesn't address the temperature problem. And there's a story on the Bloomberg terminal about what happens when the Winter Olympics can't rely on winter. And we're seeing warmer temperatures affect ski slopes, not just in the United States, but across the world. There's not really a fix for that. It's like these ski companies are investing more in what to do on the mountain when there's no snow, but the winter season is more volatile pretty much everywhere.
Yeah, that was a great piece. And honestly, it jogged my memory, and I don't know if you guys echo this, but I can't recall a recent Winter Olympics where there was an alarm about the amount of snow.
Wow.
And the temperatures. It looks like we're going to be okay this time around. But yeah, again, this is a tough problem to solve. The ski industry has tried to climate-proof their operations through basically geographical hedging. So this is why Vail owns resorts in Europe, in Australia, in the Rocky Mountains, in Vermont, and they group them all under the season pass on the pretense that if there's not snow in Mammoth, California, you might fly up to Whistler, or you might fly over to Vail. But this seems like a very complicated fix and one that might not work so well for the Olympics. But I think you will see more far-flung Olympics, maybe places where ski events could be hosted in a number of places. I know the last Summer Olympics, the surfing events were halfway around the world. We could get to a world where that happens with the Winter Olympics as well.
Or God forbid, like there's indoor skiing places,
yeah,
which we see for recreation. But I mean, there's a stat in that story about the Olympics or future Olympics. And it says, in fact, all the cities that staged the Winter Games since 1950 have heated up in the years since by an average of 4.9 degrees Fahrenheit. That's according to scientists at Climate Central. And that's well above the 1.4 degrees, that's Celsius. So 2.7 degrees they have heated Celsius, and that's well above 1.4 degrees Celsius, which is the warming average for the entire planet. And basically it says if they keep rising and we see these greenhouse gas emissions continue at their current pace, 13% of global ski areas will have lost natural snow cover entirely by 2071 to 2100, according to a study that's cited. So wow.
Yeah, not pretty. Well, a big thank you to Bloomberg senior correspondent Kyle Stock. He's based out there in Denver in the American West, and he's still gotten to do a little skiing this year.
You too, right?
Yeah.
But you've talked about this a lot this year.
A little bit of Poconos and Connecticut, New York.
Kind of crazy, what's going on. Hey, that wraps up the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Thank you so much for joining us.
Be sure to tune into Bloomberg Businessweek Daily, Monday through Friday, starting at 2 p.m. Wall Street time on Bloomberg TV, Bloomberg Radio, and on Sirius XM Channel 121.
You can also watch our daily broadcast on YouTube. Just search Bloomberg Global News. We're simulcast on Bloomberg Originals, available at Bloomberg.com/originals, and streaming platforms including Roku, Amazon Fire TV, Samsung TV Plus, and more.
Find our Bloomberg Businessweek podcast at Bloomberg.com, Apple, or wherever you get your podcasts. And the latest edition of the magazine is available on newsstands now at Bloomberg.com and always on the Bloomberg terminal.
Any skiing this weekend?
Not this weekend. We're going to go President's Weekend, though.
All right.
If we can dig our car out in New York.
I know.
Truly, if the car gets dug out.
I know. We haven't even touched ours.
I use the passive voice. If I dig the car out.
It tends to be a we project. And I'm Carol Massar. Have a good and safe weekend, everyone. Do stay warm if it's cold where you are. Stay with us, though. Today's top stories and global business headlines are coming up right now.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.